Howdy and welcome to today's 5 with Fitz. You know, the market strike me lately as a lot like that old joke about what happens when you play a country music song backwards. The dog comes home, the tractor works, the pickup truck runs, crops harvest themselves, and your last next X returns. Anyway, all joshing aside, I am very happy to see back-to-back gains simply because it's been a while since we've seen any green on the screen. Now, that said, today's action feels a little weaker to me, so I wouldn't be surprised if the computers introduced some selling later this morning, but that's neither here nor there. Possibly even by the time you read my column today or you're watching this, in fact. The bigger thought, and the one I want you to keep front and center in your mind, is that A, the big money knows that there's a lot of upside ahead, and B, they're going to be keen to get ahead of that. When? Who knows? What we do know, though, is that uncertainty always gives way to clarity. Not sometimes, not part of the time, always. So here's my playbook. Number one, is a peace deal close in Ukraine? I'm hearing reports from a variety of sources this morning that both the Kremlin and Kiev are being unusually tight-lipped about the latest ceasefire talks with the U.S. CNBC is also reporting the same. Now, wouldn't that be great? I think it could be a quick 2 to 5% higher based on nothing more than relief. Now, defense stocks will probably take a knee-jerk hit lower, but like many things, I'll take it. And I'll continue to reinvest the dividends. Then, if I'm smart enough, go shopping for more. Defense spending is sharply higher worldwide and accelerating. So, trade idea, here's one for you. I can see a 1-2 punch working very nicely. Putskis, meaning a bet that stocks will go down on a few key defense stocks, which are dirt cheap at the moment, comparatively speaking, because all the volatility is on the call side, meaning the upside. Then deep in the money call options to play the upside that will come rushing back when everybody figures out what's happening. Or, of course, you could just buy the stocks themselves, in which case you'll get the added kicker of a dividend. Now, my POV on this, my point of view, is that Wall Street is very quantitatively driven. And any relaxation in defense stock prices for any reason is almost certainly going to be driven by the computers with little or no regard for the fundamentals. That is almost always an opening for investors with a little patience and the willingness to see beyond the noise. So let's talk about number 2 today. India is mulling $23 billion in U.S. import tariff ban to protect $66 billion in exports. And so it begins. I made the comment last Wednesday on CNBC's Power Lunch that it wouldn't be long before we see which administrations want what when it comes to tariff. Now, my guess is that it won't be long before we start seeing similar deals from other nations either. Now, chances are it'll start as a smattering of tit for tat, but eventually both parties will come to the table publicly, although to be honest, I've got to imagine there is a boatload of back-channel communication already taking place. Tariffs are definitely ugly, and they're certainly not a favorite, but history shows beyond any shadow of a doubt that they can be important negotiating tools at pivotal moments. Now, to be clear, I am not saying they're right, nor am I saying that this is one of those pivotal moments, so please don't go all keyboard warrior on me. Just be aware of the broader context. Take the 1980s tariffs on Japanese electronics, for example. They weren't popular, but they forced Japan to the table and led to a rebalancing of trade and tech competition that presaged the next decade, set the stage really. The Meiji government, speaking of Japan, in the late 1800s used selective tariff reforms to renegotiate unequal treaties with Western powers, and that was an essential step in reclaiming economic sovereignty. Jean-Baptiste Colbert used protectionist tariffs in 17th century France to jumpstart French industry and reduce reliance on imports, laying the groundwork for France's emergence as a European powerhouse. So, Keith's investing tip in all this on this point is that the world's best companies have always and will always find a path forward despite tariffs. That's the thought you want to focus on. Lesser choices are a dime a dozen and not worth the investing risk, in my humble opinion. Now let's talk Alibaba, which is evidently we're late and you're not early. Alibaba chairman Joe Tsai is warning that AI data center build-out is looking frothy, and he says that projects are going up without customers in sight and hints that this could be a bubble. Says Tsai, quote, I start to get worried when people are building data centers on speculation, end quote. Fair enough, but here's the thing. This kind of warning often shows up when a company's been slow to move and needs to posture for shareholders. Now, I call this optics over operations. I've seen it dozens of times. Companies that miss the train love to act like they chose not to get on board. It's a classic CYA move I have seen over and over and over again during the course of my career. You cast out, you slow capital net outflow, and you buy time. So I say, from an investing standpoint, you stick with data center beneficiaries like those we talk about regularly. Now, my favorites continue to power up and I submit are still radically undervalued. So hopefully you got this covered in your investing as well. And if not, or you'd like a little help sorting out the wheat from the chaff, you know where to find me on my channel right here. So now let's get to Me Too, even in big oil. Shell just joined the crowd, boosting shareholder returns while cutting spending. Interesting. The energy giant raised buybacks to $3.5 billion and trimmed capex for the year, which means more cash for investors, less risk on the table. Who knew Me Too isn't just for tech? Even big oil wants in on the capital discipline trend. Now, this is an important consideration that many investors miss time and again. When companies stop chasing growth and start paying you instead, that's your cue that the game's changed. Should you buy Shell? Well, before you do, consider this. My other choice in this space has paid 38 consecutive annual dividend increases that have averaged 4.47% growth per year over the past decade. Now, Shell, great company, but has only dished out 5 years, but reflects an annual growth rate of minus 2.97% over the past decade. Nothing against Shell whatsoever. It's a great stock, and a lot of people are quite happy owning it. I just think that there are better choices out there. And finally, let's wrap up with Napster, from piracy to the metaverse. Do you guys remember when Napster nearly nuked the music biz? Now it apparently wants to save it. Infinite Reality, boy, that's a mouthful, just bought Napster for $200-something million with plans to turn it into a 3D, AI-powered, blockchain-backed concert verse. Boy, is that a mouthful. Because clearly what fans really want to watch is digital merch drop in the metaverse while chatting with a chatbot pretending to be Post Malone or Taylor Swift. Anyway, still, $3 billion raised in 3 billion raised, I think it's $12.25 billion valuation, says that somebody's buying the pitch. Now, my POV is, because I'm from that era, Napster was early once, and maybe this time it's right on cue. Meanwhile, I'm going to be sticking to rocking my vintage Bose, my vacuum tubes, and even a few of my favorite LPs, scratches and all. How about you? Today's bottom line, super simple. Chances are you've heard that old adage, it takes money to make money. It's not true. Anybody can start with no money and figure out a way to make it. What's more, the greater the effort, the faster the payoff tends to be, particularly when it comes to investing and trading. So, get started. As always, let's make it a great day. You got this, I promise, and I'll see you tomorrow.